Welcome to another edition of the RE Source Masterclass series. I'm so excited today because we have a superstar in Garth Graham from Stratmor. And some of you may not know who Garth is. So let me give him a little introduction because we have realtors and lenders on the show. Although he has spoken in Min News, we were just talking about that recently. But he's been really anywhere, talked to anybody, like any mortgage lender, CEO, executive that is faced with evolving in this market. They're probably going to Garth Graham and saying, hey man, this is where we're at. We need help. We need guidance. Maybe even showing a little bit of the books to Garth going, help us get through this. And that's not just one or two. I feel really honored to talk to you because I feel like you have a really unique perspective because the executives and CEOs are coming to you saying, hey, we really need to get through this. And I know like Stratmor is poised very wisely right now in this market because there's a lot of mergers and acquisitions. I think you guys are helping with that. People are struggling with margin compression. And realtors, don't check out when we talk about margin compression because lenders are dealing with that naughty word, margin compression. But I feel like realtors have a similar struggle with evolving and leveraging tech, discount brokerages. So I think you can learn a lot from your lender peers that are going through similar challenges. They may not be exactly equal, but you can learn a lot how they respond to that because I think that a lot of the top lenders, and Garth, you can speak to this, are going to have to evolve and change a few things. You've already seen companies right size. So when we're able to talk to Garth, just know that this guy's probably one of the most connected people in the industry right now. So Garth, thank you so much for being here. I appreciate it so much.
No problem, Ryan. Had I realized you were going to put a blazer on, I'd have done the same. So, we speak to banks and independent mortgage companies all over the country. Probably the top 200 lenders are our clients. When I go to banks, I do put on a suit. But,
it's all good.
Since you're a little bit more casual, I thought I'd get casual.
I just threw this on. I'll take it right off when we're done. Also, crazy stat that most people don't know, but your company was the first company to originate an online mortgage. Isn't that true?
Yeah, that is right. So actually, that sort of goes back to the Inman period. So I started a mortgage.com, the company, 20-some years ago, a little over 22 years ago, 1996. We were the first company to originate a loan on the internet in 96. We ended up going public. At that time, I sort of had a vision that a digital mortgage, although it was not really referred to as a digital mortgage,
right,
could make the process better, faster, more transparent for the consumer. 22 years later, I might be right.
So you were super early to the party.
Yeah, I was super early to the party, and I have the scars to prove it. And I just spent last week at the Digital Mortgage Conference in Las Vegas. Right. The idea that I was, 22 years ago was a lonely pioneer, and I spoke at Inman's conference, I think in 1999 or 98 or something like that. I remember it vividly. The idea that 1,500 people in the mortgage industry are showing up in Vegas to talk about exactly what it is 22 years later, I think we're really getting into a rapid change environment in our industry.
Yeah, I have a question about that because I missed the Digital Mortgage Conference. I've consumed a lot of it already, at least the stuff that's been put online. So I'm going to ask you about that in a little bit, and I know you spoke there. It sounded like a great event. They had some awesome speakers, and I wish I would have made it. But let me get to my first question that I think everybody wants to know. I get asked a lot. I'm sure you get asked 10 times more than I do, but I'm reading that margin compression may have subsided. We went from, I don't know the exact stat, you probably do, but losing roughly $100 per loan collectively as an industry to Q3 making more like $400 to $500 a loan, not crushing it, but at least we're not losing money. Does that sound accurate? And do you feel margin compression has subsided?
Yeah, so we work a lot of the companies in conjunction with the Mortgage Bankers Association about aggregating that type of data. In the first quarter of the year, the average independent mortgage banker, not banks, but the independent, they average about $1 billion. The average mortgage banker lost a couple $100 per loan. And in the fourth quarter, it was pretty bad. They made a tiny little bit of money. In the second quarter, they made a little bit too. But I will tell you, the tricky part about the mortgage industry is it is a low margin business. And a lot of people don't realize that. So even in the good times, you do a lot of loans, but the margin on a loan, once you've paid for all the people to originate the loan, And really, in our current regulatory climate, the climate we've experienced, it's a lot of checking checkers.
Mm-hmm.
So there's a lot of people and process and review to manage the risk elements of this. It's a small margin business. So when suddenly it gets extremely competitive, when interest rates go up and all the refis go away, you suddenly are in a situation where you are not making enough revenue to cover the fixed cost. And we had a losing, quarter in the first quarter of the year, and we had a very small margin in the second quarter of the year. And year to date, the vast majority of the lenders are roughly break even if they're lucky. The really, really good ones, or the ones that have a very specific niche, are really the only ones that are making a substantial amount of money on the origination side of the business.
Okay, so I have a follow-up question on that, Garth. We didn't really talk about it, throw you a little bit of a curveball, but rates are going up. Everybody knows that. But how does that affect margin compression? Does that make it better? Does it make it worse? Does it leave it unchanged? How does that work? How does that affect it all?
Well, all right, so I'm going to go through kind of three impacts. The first one is when interest rates go up, the immediate impact is that the refinance opportunities go down.
Right.
So the best retail originators are the ones that have focused on purchase, developed real estate relations over time, have good referral sources from realtors. They're focused on closing loans on time. So they may have the same base of purchases because the purchase market is still sort of solid, fairly solid depending on what geography you're in. But they don't have that 1 to 2 refis a month that really helps supplement their revenue.
Right.
So the margin compression, when rates go up and the refis go down, that absolutely drives margin compression because the refis are typically, you make a little more money on them. The second impact is that because the refi people, those who've lived on refinances,
mm-hmm.
who've been maybe less, focused on the purchase market, the realtor referral sources, they suddenly will cut to the bone to try to get a deal that's a purchase.
Right.
So you have tougher competition on the purchase, and you don't have the easy revenue on the refinance. So that's sort of the immediate impact, oh, wow, look what happened. I think one of the challenges for our industry, though, is a bigger macroeconomic issue, and that is really for 30 years, we've had declining interest rates on a macro basis.
Right.
So if I was being a consultant and presenting, I'd have one of those slides which, as the rates just continually going down, they bounce around within a quarter, but generally they're going straight down until the end of last year. And suddenly we are in a period where we have a generation of leaders in our industry. And I think the same thing really with the realtors who've not managed through a steady increasing environment of higher rates.
Interesting.
And it impacts you because you tell a customer their monthly payment in March when they're looking for a home, and perhaps by June the monthly payment went up by $100 if the price stayed the same.
Right.
And oh, by the way, the price went up too, and you suddenly have human beings who are feeling like they cannot chase that home. They cannot get into the home. You throw in there, the realtors know more about it than I do, but you throw in there supply constraints, i.e. not enough inventory, and rising payments and rising prices. And you've got a point where some of the people just go, I'm out, and I'm no longer going to buy a home.
That's
so
very
it's a triple whammy, not to make you feel even worse than you might already feel about what's going on. But it can be a triple whammy when that happens.
Yeah, that's a great point about lenders, even realtors, leading, managing, and selling through a market that they really have never been tasked to do. They already have enough challenges as it is, but you make a great point.
Yeah. It throws, when rates are steady to down, it means the payments are steady to down.
Mm-hmm.
Now when it goes up, your sales skills are going to be pressed because you need to know how to be 100%. Able to pivot quickly to what are after-tax payments.
Yep.
The real impact of monthly payment, the fact of rent versus own. All of these skills are much more in demand in a period when the payments might be going up than they are when a period when, hey, the last time I talked with you, guess what? It's even cheaper.
Yeah.
So, monthly payment went down, let's go.
That might be one of the best takeaways already from this interview because I think that's 100% right on, and that's going to challenge a lot of people. I won't say that the last 5 years have been easy, but they kind of have. Usually It's the reverse of that. You told them the rate it was here, and it actually ended up being here, and same with the payment, and now you have the opposite of that, and that is going to test your sales skills. And back with mutual friend Dave Savage, become an educator. That's a big part of that and how you respond properly. So next question, and realtors, this is for you too, because I've seen, and I mean, I don't know how many mortgage bankers and banks you actually work with, but I'm assuming it's 25 to 30, maybe even more. We've seen the top 10 in our world change quite a bit. And same with realtors. You got EXP and Redfin and Zillow. You know, it's different from Windermere, John L. Scott. And over here on the lending side, it's not just Guild and Caliber anymore. You got number 1 at the top, which is Rocket, new player, relatively new. And number 2, Loan Depot. I mean, that's different. That's a new world. What do you think about that? I mean, is that just more to come? We're going to see new players continue to emerge, or is that going to slow down at all?
Yeah. So in the origination cycle, origination, not servicing. So let's focus on the origination for right now. The independents have risen substantially. Over 50% of all volume is now going to independent mortgage bankers in lieu of banks. And I'm talking about origination. The money of the originators may sell to aggregators who are banks. So it may end up at a bank. But the originator, the person taking the loan and getting the loan to closing, the independents have been dominating. And part of that dominance, and it's not likely to dissipate in the short term, is because they generally have been more focused on purchase business and referral sources. And that purchase business and referral sources is because that's all they do.
Right.
They only do mortgage banking. They don't also do home equity loans and bank accounts and things like that. Banks have traditionally been a little more cyclical in their treatment of the industry. They go in and out. And then the other major compelling part is the banks have generally been reluctant to go all in on the government loan business. And there's exceptions. So my banker friends out there, you know, apologize in advance for the generic statement, but generally they've not been as fond of FHA loans.
And can you talk about what their trepidation is on that for like maybe the realtors watching?
You know, the big ones that are in the headlines is literally the headline risk associated with some of the False Claims Act that was done by the FHA.
Okay.
And that's really a big part of it. You know, the second part is the other element here, if you are going to do purchase loans, you will close them on time.
Yeah, you better.
Period.
Yeah.
You better. And thus, the independent mortgage bankers generally are very refined in their processes to close loans on time. And they are very quick and nimble to react to change in market conditions. And where the banks will tend to be slower. Now, they have amazing portfolio products for the jumbo market, and there's certain things they do really well, but they just are less likely to react as fast, and they've also traditionally had a staple of refinances to count on.
Right.
They retain the servicing, they can cross-sell bank customers. So there's all sorts of reasons their model works well in the overall, but in this market, i.e. rise in interest rates, heavy purchase, and you better close on time. And a high percentage of first-time purchases are first-time purchases, and a high percentage of those are governments. You combine that, it's an independent mortgage banker's market still.
That's good news for the independents, right?
Yeah.
Yeah.
Yeah, good news for the independents.
Yeah. So
the trick, by the way, the flip on the independent is when margin compression is hitting and they're losing money, it's a person's money, or it's a equity fund who might have invested. It is someone who probably may not have a long-term willingness to have below zero margins in the mortgage industry. So that is what's driving a lot of the M&A activity we're involved in, or consolidation, is because there's an owner of a company with retained earnings where his capital is eroding in months, quarters, when he's losing money. And not, I'm not saying everybody is.
No, I mean, we could spend
losing money.
An entire show on that, and it's fascinating. And again, for our realtor friends, I'll try to explain, and you can clean it up again. But what Garth is saying is, you got an owner or maybe a hedge fund or somebody that really is funding maybe a lender, and the loan officers, the executive, maybe the CEO have the appetite for this type of cutthroat market, but the people actually funding it may not. They may want to see better returns, and the people that the lenders that depend on that, and I think we've already seen it, may have some of that funding pulled, which is going to make it tough to make it through a market like this. Did I say that correctly?
That's right.
Yeah.
Yeah, absolutely. And you know, if like I said, there's plenty of independent mortgage bankers who are able to. Oh, that's pretty funny. I guess I haven't been moving around enough. My
Your light shut off.
But yeah. In fact, the lender I'm at is hurting so badly that they didn't pay their electric bill, and the lights just.
That's how bad it's got. We can't keep the lights on anymore.
So yeah, I mean, there's plenty of independents who are weathering the storm. Some of them will have a servicing base, and the servicing they make money on a little bit on a lot of loans, and that certainly helps.
Gotcha. So the conference that I missed that you spoke at last week, Digital Mortgage Conference. What was your biggest takeaway real quick, maybe top one or two, because I felt like that was a great conference, just the stuff that I was able to consume. What was your thoughts speaking and hearing the speakers there, like biggest top two takeaways?
The first one is the number of products that are being offered in the marketplace. Just in the past 3 years, and I've spoken 3 years in a row at this conference, is substantial. The number of lenders, the amount of digital tools. So just the sheer volume of people who are focused on the digital mortgage environment is, you know, very impressive. The second is I think people still have a lack of appreciation for how much it requires people, process, and technology to make meaningful change in their companies. Mm-hmm. And the reason is they'll go there and they go shopping and they see a product, the technology, and they say, oh, I just need one of those. And we, at least in our business, caution lenders and say, you've got to have a process that drives people, process, and technology change to bring the benefits out from the technology itself. So that is my biggest challenge. It's the one I led with in the first minute of my speaking engagement.
Love that.
This is a people, process, and technology challenge. It's not just pick the shiny object. And by the way, I think the realtors on the phone here, whatever sort of, whether it's a co-marketing solution or you're doing Zillow leads or you're looking at realtor.com models or your real estate firm has a whole series of technology solutions, all of these things can be helpful, but you need to focus on the people and the process and be sure that the people are able to change their process in order to drive the sort of adoption that's necessary.
Right.
So those are the two biggest ones. And the other one is we do a survey of leading lenders. Like, by the way, our client list is roughly most of the top 200 lenders. And we did a survey 3 or 4 years ago, and we said, what is the biggest thing that you're spending money on and why? And the biggest thing they were spending money on 3 years ago was compliance, and why was regulation. And buried way down the list was customer service type items.
Interesting.
This year, number one, the digital mortgage capabilities, and the number one reason is customer satisfaction. So that is extremely encouraging because at least the industry has begun to go through perhaps the other side of our regulatory climate and beginning to focus on what it is that drives high levels of customer satisfaction.
Right.
I'm back to my challenge to get that satisfaction at people, process, and technology.
Yeah, and I think that if you look at that top 10, you'll see that some excel in technology, maybe not the people, and some traditional excel at the people, but maybe not the technology. And it's going to be interesting. And I think the people that win out are the people that can merge that. I've been saying that for a while. You just said it in a different way. That was beautiful. So I love that, and I think that's who's going to make it through a tough environment is the people that can blend all three of those. So 100% right on.
I'm not often referred to as beautiful, so thank you, Ryan.
So you were talking about technology, and it's easy for loan officers and realtors to kind of sit back and say that margin compression and big technology and CRMs, that's just for corporate. And that's a corporate problem, and they need to figure it out, and they need to provide me technology. And some of that's true. But why is it also on the loan officer and the realtor? Because you'll talk to people at Keller Williams from Redfin, EXP, and it's funny. Every place I go, no matter if it's loan officers or realtors, lenders, real estate companies, they all complain about their technology, no matter if they are perceived as the best. And I always feel like they just kind of push it off on corporate or executives. But I feel like it's also a loan officer challenge and a realtor challenge, but I understand they kind of feel helpless. They don't get to go spend the big bucks to do it. But is that true? Do you feel it's just on corporate, or can loan officers and realtors help out, for all those challenges with tech, with margin compression?
Well, I mean, I think it's both. By the way, the big item that we also see with our lenders, and we sort of challenge them on this, is 40% of the loan officers in our industry do 80% of the business.
What?
And
say that again. 40%
do 80% of the business.
Wow.
It's not quite 80-20 rule.
Right.
80-40 rule.
80-40 rule.
But it is the top producers, those who've been at it a while, have good referral sources, been valuable in their communities for years, are highly productive. For them, technology is different. It needs to make them more productive.
True, 100%.
So low producers will have a different level of complaint because it needs to make them productive, period. So meaning the technology is not going to solve the inability of a certain loan officer or realtor to develop meaningful relationships in the community and have a value proposition for homeowners. It's just not going to solve that.
Love that.
If the technology, a whole series of online technologies, mobile applications, automated marketing solutions, enable high producers to free up time, they suddenly have more time to develop relationships.
Yep.
So for us, when we work with lenders, we actually go through a whole process where we, survey all of them, and then we put them into benchmarks, the high performing rookies, and then what do they feel about technology? Because everybody's a little bit, there's different cohorts. And I think lenders have to be smart about it. As far as your question, like if I'm a loan officer or I'm a realtor, you got to be smart about it too. You have to embrace it and say, what is this? How is it going to make me more productive? And I think the biggest thing is when lenders become too focused on the average. Mm-hmm. And it's really, you need to be focused on the high producers.
Yeah, so I agree, and not to get right in the faces of the loan officers and realtors watching, but I think what you're saying is technology can't make an average producer better, but it can make a good producer, great, because it doesn't make up for your lack of genuine sales skills. No offense, but you're right. It's there to enable them to make them more efficient so they can spend more time doing what they're good at, which is making relationships and building different sales funnels. But I think a lot of times loan officers and realtors have this misconception of, I'm going to get this new piece of technology and suddenly I'm going to be relevant and a top producer. No, you're not. An NFL player gets to the NFL and they're already NFL quality because they deserve to be there. They don't become an NFL player just because they got a contract. It's the same with a good producer getting good technology. It just makes them better.
Right. And by the way, for the NFL analogy, you just have to be careful you don't rough the passer.
Good Lord, man. You can't touch him anymore. You got to pick him up, gently lay him down.
Lay him down.
Oh, man, that's going to have to change.
So the one thing I'll say, too, is the digital mortgage not only could make you more productive, it may actually give you the chance to be highly productive and have a life. And I have seen ones where when we survey loan officers who will then say, it has made me actually able to, get to my kids' soccer games or, be more present in my home. And it's the opposite of what you think about. Like if I'm totally tethered to my phone, less engaged with the world around me, maybe it's a bad thing. The right technology, looks like, let's say you have a great online application that enables a borrower to complete it in a very slick 10-minute interview that's totally intuitive.
Right.
It makes it easy for them. They pull through. Then the loan officer gets a notification on a cell phone that says it was just complete. The loan officer can pull that up and say, ooh, I think the realtor is going to want to know this. Let me produce a pre-approval letter and send it to them, all without ever logging in or going to any of their offices. Yeah. They could do that at the ball field watching the kid, and then have hit a button, call the realtor and say, hey, look, they just finished their online app. It looks really good. I sent you an online approval. What else can I do to help you with this customer?
Yeah.
That's a value-added conversation.
Makes us more efficient.
All of that is available.
Yeah, right now. It's even getting better, but it makes us more efficient. And then back to your other point, drives a better consumer experience, which I'm happy to hear that the industry as a whole is focusing on that consumer experience versus regulatory, which is important. But really, the consumer is the most important person in the process.
Absolutely.
So I'll wrap it up for you. Thank you for your time. I got a weird question, but again, with all of your knowledge, and you're working with so many different executive CEOs and companies out there, would you make any bold predictions for 2019 here on the Resource that you'd like to share? Any crazy or bold predictions?
I think the biggest one that's almost really very little contention is there's going to be dramatic consolidation. Yeah. And that will mean the consolidation will occur at the lender level. So there's mortgage bankers buying mortgage bankers. There's mortgage bankers merging in order to leverage their fixed costs.
Yep.
But it's also going to occur at the loan officer level, because I think pretty quickly, if you are the type of originator in that bottom 40 to 60%, by the way, the attrition rates are already in the bottom 40% of loan officers are over 100%.
Right.
Meaning they leave their company if they're that low. And at some point, they're going to leave the industry. And they're going to leave the industry because they don't feel that interest rates are coming back, the refis are going to help them, when they just don't have the relationship skills or, the willingness to stick it out in a tough time. So I think we will see loan officers leave the industry, so that will consolidate. I think we'll see independents especially begin to consolidate, merge, and sell out amongst others. And the wild card in the whole thing is whether banks will re-enter the mortgage origination space in any significant way.
Yeah.
Because obviously they have extremely deep pockets, and they've got all sorts of money. They're really, at this point, with exceptions, but they're mostly dabbling around doing jumbos. But the question is whether they'll re-enter the market in any substantial way. Yeah. That's a wild card, but I'm darn sure there's going to be consolidation in 2019.
Yeah, I agree with all that. I think we've already seen some of that bottom tier exit. And I think it'll continue, like you said. Krishman had a good article in his report, who's part of Stratmor now, I believe. But I think he said even with that bottom tier, even without like a draw, I think it was like $3,000 to $4,000 per month just to keep a person absolutely. Like that on. And if you're running a business, it's a pretty easy decision if that person isn't producing, that you're going negative pretty quick. And so I 100% agree. You're going to see that bottom quartile drop, but it could be good for the people that are left because you have fewer competition, a lot fewer competition, and maybe we'll see the average loans per loan officer increase in the coming years.
I think it's going to 40%, 80% might begin to consolidate.
Yeah.
We may actually see that the high producers become even more productive, especially because of the digital tools, and they're even a bigger percent of the market.
Yeah, and to wrap it up, maybe you can say something too on a positive note. I struggle because every time I talk about this, people get down, they get sad. First of all, it's just reality, right. And second of all, it doesn't mean that the mortgage industry is imploding. Your realtors, right. You're still going to be able to work with your high quality loan officer. It's going to look different, guys. We're all going to have to evolve with it. Lenders included, CEOs, executives, loan officers, realtors. You're going to have your own challenge that you're going to have to evolve as well. So it's not doom and gloom. It's just different, guys, and we just have to roll with it.
Yeah, absolutely. And I think with the whole margin compression piece, if you were doing significantly more units, you may make less money on every single unit, whether you're a realtor or a loan officer. Nobody wants to hear it.
Right.
But if you're doing substantially more units, you may be making more money. And oh, by the way, if you do a lot more units, you have a lot more referrals,
right.
And everything begins to repeat into off itself. Plus, it means your paycheck isn't, one loan is not a fourth of your paycheck or an eighth of your paycheck. It's suddenly, hopefully a 16th of your paycheck.
Right, right.
So you got a much more steady base of business. You've got higher productivity, hopefully through digital tools. There's certainly an opportunity for the right people who, once again, can have relationships and have meaningful relationships in their local communities and provide value to consumers in the home buying circle. I think you're still going to be advantaged.
100%.
If you can't do those things, though, there's opportunities in other industries for you.
Several good takeaways, man.
Tough industry.
Well, I love it. Thank you. Several good takeaways today. I appreciate it so much. Thank you for your time. I know you're super busy. I appreciate you just carving out this time for us. Garth Graham, Stratmor Group, if you guys want to connect with them. If you have questions, put them in the chat log below. We'll see if Garth can answer them. I'll try to get to them as well. Thank you again. We'll see you next time.